This is learning objectives 4, 5, and 6, because none of them are very long. So workers' compensation insurance is an expense for the employer. It comes out of the employer's pocket. And the employer is required to purchase insurance to protect the employees if they get any work-related injuries or disabilities. So if it happens like on the job or it's somehow related to the job, then they have insurance, and the employee can collect benefits from this fund. And the laws requiring this and the different amounts and the rates differ state by state. The premiums are often calculated based on whatever the employment classification is. So for instance, let's say you have a construction company. What is paid in workman's comp for the construction workers would be different than what is paid in for the employee that's making the bids on the jobs, and that would be a different classification than the accountant or the president of the company. And you know, it's based on risk risk of injury, and they're often stated in terms of $100 per payroll. So it might be like if your total payroll is $10,000, then it would be take 10,000 divided by 100, and you get 100. And so it might be like $5 for every $100 worth of payroll. So 5 times 100 is, 5,000. That's kind of, 500 rather. And these premiums are paid in advance based on what you project you're going to pay your employees. And then at the end of the year, you file a report. This is with the state that says, okay, these are the actual wages. And if they're more than what you projected, you're going to have to pay an additional premium. And if they're less than what you projected, then you may receive a credit towards the next year's insurance. The journal entry to record this would be, so for instance, this is rate per $100. So this 1,000 divided by 100 is 10. So 10 times $9.08 is $90.80. 845 divided by 100 is 8.45 times $1.05 is $8.87. So this is what they would have to pay in, and you would debit the workman's comp insurance expense for the premium paid, and then credit cash if you're going to pay, or insurance payable if you are accruing it. And that's what the journal entry would look like. Next one, recording the deposit of payroll taxes. So you're going to look in the general ledger for the amounts that are due, because you would have already written this down, and then like what was supposed to be paid in. And now you're actually going to deposit the 941 taxes. And so you're basically paying off these liabilities that were created, and you're going to credit cash. Okay, and again, you're probably writing a check or doing an electronic funds transfer, but either way you would credit cash. That's why you have to look in the general ledger, because you would have already accrued these liabilities and now you're paying them off. Then state income tax, that goes to the state, and so you would have accrued this liability, now you're paying it off by debiting the liability, crediting cash. SUTA, same thing. The hard part has already been done in that you've already created the payable. Now you just have to show that it's being debited and credit the cash. Then at the end of the period, you have some accruals. Remember, back in your financial accounting, you have to do adjusting journal entries. There are always, well, often adjusting journal entries that relate to payroll, because you have wages that have been earned by workers but not yet paid, simply because the end of the pay period, like well, the end of the year might be December 31st, but the end of the pay period might fall in between pay periods. That's a better way to say it. So you need to accrue wages for however many days worth your employees have already earned, and then credit the wages payable, and then when you actually pay the wages, you'll debit that wages payable. And any accrued vacation pay should also be recorded. And a lot of employers are now merging sick time and vacation time. And I think this is probably because a lot of employees, they might want vacation time, and they're very healthy, so they're going to basically call in sick when really it's for vacation. So a lot of employers just come up with a policy that says you get, X amount of time, whether you're sick or vacation, we don't care. So the journal entry, to do that, you would calculate what is the amount of vacation pay earned by the employees, and then credit vacation benefits expense and vacation benefits payable. It's not necessary to accrue the payroll tax expense at the end of the year. So for instance, on this accrual, you don't have to go in and calculate what would be the payroll tax expense for just this, because really you don't, the payroll tax doesn't become a liability until you actually pay your employees and withhold the taxes. So that's why you don't have to accrue payroll tax expense, and as accountants, we're all relieved about that, because that could get kind of complicated.